Good morning and good afternoon, and welcome to the third IAIS Annual Conference 2021 panel. I'm your moderator this morning, and I'm Suzette Vogelsang, the IAIS Exco Third Vice Chair representing the Emerging Markets and Developing Economies IAIS membership. The topic for today is on pandemic protection gaps, with a particular focus on the role that supervisors can play. But before we start, just some logistics for this webinar. If you have any technical problems, please use the WebEx chat function and our technical team will be happy to help you. You're also welcome to use the chat function to ask your questions. And as we want to keep this panel as interactive as possible, and during today's discussion, we will therefore also conduct a couple of polls. So please share your views with us. The polls will be displayed on the right-hand side of the WebEx panel in the chat function once announced. So let me start with introducing our topic today. COVID-19 has highlighted the limits on types of coverage that can reasonably be offered by the insurance sector alone. This is relevant for types of cover where a diversification of risk required to support viable insurance cover is difficult to achieve. It is also important to acknowledge that the challenges faced in developed and emerging markets and developing economies are very different, given both the different starting point, including the lower penetration rates of the insurance sector in these EMD jurisdictions, and the different fiscal pressures on governments. Taking steps to close protection gap caused by or accentuated by a pandemic is a complex task that will likely require a multi-stakeholder approach, bringing together governments, supervisors, consumers, and the private sector. As approaches to mitigate against pandemic risk are developed, supervisors will need to consider a range of issues. These could include whether the risk sharing being taken on by insurers is sustainable from both a micro and a macroprudential perspective, whether the adaptation and risk prevention aspects are considered, as well as supervisors may also need to consider whether such approaches will be effective in improving access to pandemic risk cover. The IAIS, together with the Access to Insurance Initiative, has been looking at this issue as part of its 2021-2022 roadmap, including a project comparing and contrasting different approaches being undertaken by supervisors. The project will also consider approaches to other types of risk and whether there are lessons that can be applied to pandemic risk. So the intention of today's panel is to explore some of the complex issues related to pandemic protection gaps. The structure of the discussion will be to start off by setting the scene in considering what we mean by pandemic risk and protection gaps, and what has changed in our understanding of these concepts since the outset of the pandemic. We will then move on to consider response options, including shared solutions. We will then seek the views of the panelists on the role of the supervisor in supporting initiatives to address pandemic protection gaps. And finally, we will look ahead to consider how we can apply the lessons of COVID-19 to future adverse events or risks. Now, to assist us today in understanding these important issues, I'm very honored and pleased to introduce our panel for today. First, Mr. Arup Chatterjee, Principal Financial Sector Specialist from the Asian Development Bank, Ms. Petra Hilkema, IOPA Chairperson, Mr. Cameron Murray, Head of Government Policy and Affairs, Lloyd's of London, and Kai Shantz, Head of Research and Foresight at the Geneva Association. Each of these panelists brings a wealth of experience and different perspective to these issues. So let us begin. I would like to start by setting the scene of what we mean by pandemic risk and pandemic protection gaps, including whether our understanding of these concepts has changed in the past year. So Kai, if I may start with you, what are the most significant pandemic risks and which protection gaps have most been exposed? And have you observed any changes over the last 18 months?
Thank you very much, Suzette. Good morning, good afternoon, good evening, everyone joining this panel. Well, I'm happy to share the research that the Geneva Association has conducted on various manifestations of pandemic risk and the associated protection gaps. We have been looking at three specific areas. Of course, business interruption, but also health and mortality. So practically speaking, I mean, protection gap, this sounds like an abstract concept, but practically speaking, we are looking at the prospects of businesses defaulting within weeks. We are looking at households potentially facing catastrophic healthcare spending due to unexpected burdens from COVID-19. We are looking at households facing impoverishment if the main breadwinner dies. So these are the concrete calamities that we are discussing. Starting with the pandemic business interruption, I think we are all familiar with the figures, with the proportions. I think probably a very powerful figure is what the OECD estimates in terms of global economic losses from 1 month of hard lockdown measures. So one month of hard lockdown measures would come at a price tag, if you like, of $1.7 trillion US. 1 month in terms of lost revenues in vulnerable segments such as accommodation, entertainment, food, etc. So the 1.7 trillion is quite similar to the capital base of the world's P&C insurance industry, quite similar to the premium base of the world's P&C insurance industry. And this figure alone illustrates that there are significant limitations as to what the insurance industry can do. And we could ask, is it the right thing to talk about the pandemic business interruption protection gap? Because if we talk about protection gaps, we suggest that the insurance industry can do something about it. Maybe we should rather look at the insurable protection gap versus the overall risk, economic risk protection gap. So that's BI. We also looked at the health protection gap, which is frequently underestimated. We have countries such as India and Russia where most healthcare expenditure is out of pocket, and you can imagine what's happening in these countries if a calamity like COVID-19 strikes. So this is something we will not focus on today, but I think which also needs to be taken into account. And last but not least, the mortality protection gap. Let me give you Latin America as an example. Prior to the pandemic, a huge mortality protection gap. Then add to that the significant excess mortality levels that the region has seen, and you can imagine which sort of hardship was involved. Now, coming quickly to the second part of your question, Suzette, what has changed over the past 12 months? And we actually conducted this research a year ago. Obviously, a number of things have changed. The BI protection gap apparently is much less of an issue. Also, when you look at the policymakers' agenda, the prospect of more nationwide lockdown measures seems to have disappeared, and governments are now embarking on much more targeted measures to stem local outbreaks. On top of that, we have vaccines. We have the prospect of treatment, which at least has successfully brought down mortality and hospitalization rate. In addition to that, and more generally speaking, I personally do not think that history will simply repeat itself. Governments have learned a lot, for example, in terms of what they should do when it comes to limiting international travel at a very early stage. Businesses have learned a lot in terms of what to do differently in business continuity planning. From that perspective, you could argue that the future protection gaps in also pandemic business interruption might be actually smaller than what we have encountered in the first quarter of 2020. All public and private sector stakeholders, I think, have learned a few lessons. Thank you.
Thank you very much, Kai. I guess the one thing that we've observed as an unexpected is the COVID long effects from the pandemic and the impact that has on morbidity claims in particular. All right, thank you. So Pietra, why is it necessary to address pandemic protection gaps in your view?
Yes, thank you, Suzette. Thank you, everyone, for being here today. It's good to be in a session, even though virtually, but just to share ideas globally about a pandemic that had a very global character, but that has a very diverse impact. And the reason why we have to look into pandemic protection gaps, I think, is twofold. First of all, the cost of the pandemic protection gap to society, also in the longer term, are severe. And I think Kai Uwe and you both just gave some examples of why that is from an economic perspective. So I won't repeat that, but I very much concur with that. Also, the social challenges and the inequalities that were there already before the pandemic in the world, but also in societies, have worsened. Unemployment rates have gone up in some parts. In other parts, there is really a disruption of supply chains and the labor market, and resulting in new differences between groups that are already maybe not as advantaged as we would like them to see. And I think of low pay income countries and groups in society. I think about women, I think about the young. I also believe that the worldwide closures of schools will have an impact and can have an impact on the economy in the long run. So overall, a repetition of this to the extent that we can learn from it and prevent this impact in the future would be very important for society as a whole. Now, this won't be easy because we are not just recovering from a pandemic, but at the same time, we're dealing with challenges like climate change and digitalization. So it will not be an easy road. But we need to think about it. And here I hear also what Caillou said. I think there's a lot of lessons to be learned. Next time won't be the same, but also hopefully because we have learned on what we can do. And then if you make that specific for insurance, what you see, for example, for the non-damaged business interruption losses, less than 1% of global GDP losses induced by the pandemic through business interruption was insured. So that leaves a 99% that was not insured, and that is something to look into. I think another thing to look into is that what is a trigger of these events actually becoming or no longer becoming insurable. I think we have a lot more new information and data to actually invest in modeling of potential risks and look forward through public-private initiative to align views on prevention and thereby also reducing moral hazard, but also being aware of what you insure for, and then see where the gaps are. Now, finally, when it comes to trust, which is also very important in society. I think another reason why we have to look into it is that many people thought they were insured and they were disappointed, and others were insured, but the claims handling didn't go as well as they wanted it to be. So here again, I think it is very important that consumers understand better what products they have, what exclusions are there, and also make an assessment whether or not they want to get then additional insurance. So all in all, I think it's very necessary that we learn from the lessons, we help the recovery, but we also ensure that for going forward, the impact of a next possible crisis at a systemic level will be less. Thank you. Stop here.
Yeah, no, thank you, Pietra, and you're 100% right. There are a lot of challenges, and it's critically important that we do address those challenges and the lessons learned from the pandemic. Cameron, if I can move to you now, having listened to both Kai and Pietra, are these risks uninsurable from your perspective?
Well, I mean, I think the Geneva Association's report that Kai referenced from last year is pretty clear on this. It's pretty conclusive. I mean, certainly when you're talking about P&C business, I think pandemic risk is fundamentally not insurable in the private market, not at least at any scale. I think life and health are a different matter. Pandemic life and health risks are generally viewed as non-systemic, and therefore they can be insured in the private market. But as far as the PC market's concerned, the actions that governments and public authorities have just had to take over the last 18 months to 2 years around the world to limit the spread of COVID, and indeed may have to again if something like this strikes again in the future. And of course, I'm talking about national lockdowns specifically that have effectively shut down entire economies. Those sorts of actions remove any element of randomness or independence. And that means that pandemic risk basically becomes impossible to diversify like other large-scale events, such as terrorism and natural catastrophe, where you can have that degree of diversification across the risk, generally speaking. So the net result is everyone is hit everywhere at the same time. And in those circumstances, the sort of fundamental premise of insurance, which is that, the many pay the losses of the few, can't operate. And then when you factor in the numbers, and Petra and Kai-Uwe have referenced some, and the fact that the industry, just doesn't have the capacity to absorb the kinds of losses we're looking at, the issue sort of becomes academic, really. The entire global P&C industry is estimated to be somewhere between 1.6 and 2 million trillion US dollars in premiums. And the size of the global financial stimulus package just to keep economies going and aid recovery from COVID-19 over the last 24 months, last time I looked, was about 10 trillion US dollars. It's probably more than that now. So the numbers, really speak for themselves. However, you may have noticed that I said pandemic risks not insurable at any scale. And that's because, as some of you may know, last year Lloyd's put forward a concept called restart, which began with the premise that, if you can keep policy limits low, and if you can keep the customer base sufficiently diverse, either by geography or by sector, so that all the policyholders are not impacted at the same time. So, as Kai-Uwe just referenced, if governments can avoid national lockdowns and limit their interventions to more regional or local ones, and then if you can get enough carriers on board, it might be possible to offer limited, and I stress limited, insurance cover on commercial terms for SMEs against future waves of COVID. It's not the whole solution by any means, but it would be a solution potentially that you could roll out without the need for government intervention. And there are still some plans in the Lloyd's market for a restart type product, but it's not yet ready to be rolled out. And so for the moment, it remains a sort of theoretical solution only. So I think for the purposes of this panel, it's a long answer to your question, but for the purposes of this panel, I think we can say yes, broadly P&C, pandemic P&C risks are generally uninsurable. But I would add, and it's an important proviso, and one I guess we'll come on to later on, even if the insurance industry can't wholly insure these risks, it still has an essential role to play, I think, in any solutions that are developed to manage and mitigate pandemic and other systemic risks.
Yeah, thanks, Cameron. At least it sounds like there's a little bit of hope with some adaptation and some innovation. Thanks, Cameron. So, Arup, to you, has the pandemic highlighted the same set of protection gaps for the developing countries?
Thank you, Suzette. The pandemic protection gaps are something which are quite different in the developing economies compared to the developed ones, primarily because the insurance market is not developed, and also some of the automatic stabilizers in form of health insurance, social insurance, and similar institutional mechanisms are either weak or are absent in these developing countries. So as a result of that, the counter-cyclical mechanisms, which represents the most effective instrument to address the challenge of financing, to address the financing gap, is missing, and therefore governments have to resort to pro-cyclical nature of social spending, and which is a key challenge. So governments also have, in a sort, have played a limited role and at the same time, the insurance markets have been absent. So that is to put things very, very candidly in a sense. But in addition to the pandemics, we have also witnessed in Asia, especially. I come from the Philippines now, where we are at the ring of fire. We are having multiple disasters. It's not only the pandemics. We had volcanic eruptions. We had cyclones. We had earthquakes. So all these multiple disasters also stress the balance sheets, both of the government and also of the insurers. So that is the other challenge which we have seen governments facing. The third thing which we have also seen is in terms of addressing the protection gaps. So some governments have also allowed withdrawal from the pension and superannuation funds. And as you know, there are certain regions in Asia which have a demographic dividend, others don't enjoy. But to solve one problem, sometimes you don't know what you are doing with in terms of managing the longevity risk, whether that problem really, the solution is really a good solution in that sense. So that is the other aspect. And I think finally, I would also like to stress that while the pandemic has been a great leveler, it has also brought in forth the different divides at the same time. We see a gender divide because more women are likely to be excluded from financial inclusion and financial instruments. We find that there is a digital divide because not everybody has equal access to all these digital tools and instruments. We also see there is a vaccine divide because some countries have the luxury of getting vaccinated first and compared to the rest. So those are some of the things which we also need to understand in terms of offering broader protection solutions, either with the help of the government and or in public-private partnership with the insurance industry. So in a sense, we need to address some of the market failure related problems going forward. Thank you.
Thank you very much, Arupan. And just to say that I fully relate to that, most of the things you mentioned also coming from South Africa and an emerging market. So thank you very much for that. So we're done with round one of our questions. And to conclude this round, I would now like to turn to you, the audience, with our first poll. So as indicated earlier, the poll will appear in the chat function. So let me just pause to allow our technical team to get the poll up and running. Okay, it looks like it's there. So let me read out the questions, and then you can then look at the options and provide us with your response. So what is the most effective mechanism for managing the business interruption protection gap caused by the pandemic? So whilst you respond, we will now turn to our second round of questioning. In this round, I would like to explore response options, starting from the assumption that market-only approaches to addressing pandemic protection gaps cannot be found. So, sorry, Kai, you're up again first. So, what are some of the solutions that have been taken across the world, and what can insurers bring to the table?
Thank you very much, Suzette. Well, as we discussed before, the private insurance market is simply not able and never intended actually to provide substantial coverage for pandemic BI risk. So that implied that governments actually had to come to the rescue, if you like, with no pre-event financing, with no pre-event commitments as to how to allocate funds. So governments essentially had to react to the pandemic as it unfolded, the necessary funds, and Cameron gave the figures. necessary funds were largely borrowed, which puts the burden on current and future taxpayers. One of the most striking examples, probably the CARES Act in the U.S., with a volume of more than $2 trillion, which deployed support funds to workers, to households, to small businesses. Now going forward, and moving to what to the second part of your questions, is that what can insurers bring to the table? Well, going forward, governments could obviously adopt a different approach. They could, for example, provide voluntary insurance directly to those who are exposed to pandemic risk. The government could collect the premiums. The government would be allowed to borrow funds if, when a pandemic occurs, the level of the accumulated premiums is not yet sufficient. There are examples of such schemes in the traditional NatCat space. In the United States, the National Flood Insurance Program, which is run by the government and where insurers assist in marketing the policies, they assist in settling the claims, but they have no real skin in the game, if you like. One that may not sound satisfactory, but at least it could address one of the weaknesses that was exposed by ad hoc government responses, and this is the matching of funds with needs. In a number of countries, we have learned that this has proven to be a major weakness of this post-event response. Some people received more than they needed, and others fell through the cracks. I mean, this is an operational issue, but it was a very painful one for a large number of people. And if, based on insurance involvement, even if there is no skin in the game, we can address this mismatch, I think we would have achieved a lot. On top of that, and maybe more ambitiously, and Cameron alluded to that, the insurance mechanism, one of the key strengths of the insurance mechanism is to provide incentives for behavioral change. And I think government should really harness this potential role of insurance, in terms of designing policies that incentivize for preventive measures, that incentivize businesses to invest in ex-ante business continuity planning, to invest in teleworking, to review their cybersecurity policies, etc. So many small things that I think could be very effectively incentivized through a properly designed insurance policy. So these are my thoughts, Suzette.
Yeah, no, thank you very much, Kai, for that response. I mean, in our country, we've got a dedicated government insurer providing cover for political unrest and riots because the market couldn't cover that. So, yeah, no, I understand that by what you said. So, Cameron and Arup, if you can in turn respond to the following question. What could a public-private partnership look like to address pandemic risks? Cameron, if you can start, and then Arup.
Thanks, Suzette. I think it's become quite clear, really, over the months, that while there is sort of general agreement on the need for the insurance sector and governments to share the load, as Kai suggested, on protecting society against any kind of systemic risk, not just pandemic, there isn't really a clear consensus on the way forward on the sort of precise mechanism that's needed, I don't think. So for that reason, and given also that there are already a number of different models in existence around the world covering terrorism or flood or civil unrest, as you suggested, I mean, it's unlikely that we'll be looking at a one-size-fits-all solution. But Lloyd's set out its thinking on this pretty early on in the pandemic. Actually, it was July last year. It didn't feel particularly early at the time, but sadly it turned out to be so. And we published a white paper which we called Supporting Global Recovery and Resilience, Customers and Economies. And that included a set of open source frameworks, 3 ideas on developing resilient solutions for society and that could potentially address the challenges presented by future waves of COVID, but also over the longer term for other systemic risks. I mentioned Restart already, and that was one of them, but there were a couple of others. One focusing on pandemic specifically, and the other looking at a wider solution for a range of systemic risks with potentially equally catastrophic effects. So that second concept we called recovery, and it kind of flipped the insurance concept on its head in a way. So it was designed to meet the short-term need of settling claims from potential future waves of COVID, but it was formulated around the idea of a long-term contract where claims for pandemic-related losses would be paid upfront. In other words, before the insurers had built up a premium pool. And you could do that on the basis that the insurance contract was for a long enough period for the insurer to then be able to kind of recoup the cost of the claims through premium payments paid by the policyholder over the lifetime of the contract. And so you'd really need the primary cover being offered by insurers to be on a 10 to 20 year basis. So that was the idea. You pay the claims up front and then you recoup it, amortize effectively the premium payments over a longer period. There are a couple of challenges with that. One is obviously you've got a counterparty credit risk, and we think that's where the government might need to step in. So if your policyholders are unable to maintain their premium payments over the term of the policy, that risk would either need to be mutualized or reinsured to government. Otherwise, the premium cost would just be too high to be affordable. And you might also need the government funds up front if an insured event occurred early on during that contract term before you'd built up the premium pool effectively. And then I think the second challenge is and I think particularly one that regulators would have to deal with, which is how do you resolve tying policyholders into a long-term contract, and how would that fit with treating customers fairly? And our thinking around that was maybe you give the policyholder the ability to switch providers like you would have with electricity companies or utility providers, for example. So that was recovery. The third concept we called Black Swan Re, and that's for a wider systemic risk. But it's a model that will be familiar to you, many of the audience, and it recognises that, as Kai suggested, to really write systemic risk at any scale, you need sovereign wealth, basically government funds, because currently systemic risk is basically sitting with the customers that it affects and with the governments that then, obviously, as we've seen, step in to provide protection, as they've done for COVID. What Black Swan Re would do would create instead a state-backed reinsurance structure, where the primary insurers would offer non-damage BI, business interruption, and then beyond an agreed retention, would cede the remainder to a government-backed insurance pool, like we have in the UK, for example, for terrorism with Pool Re, but with a broader scope to cover all, a range of systemic risks. The benefit would be that it would ensure a commercial layer for systemic risks, as well as a pool of funds which would build up over time before government funds would be needed. That's the theory, but they inevitably would, as we've discussed. But then you'd also have commercial modelling and commercial pricing to ensure that the risks are at least partially paid for by the businesses that benefit, and we think that's important. And again, coming back to what Kai said, the understanding and risk mitigation by the customer, that's encouraged and that becomes part of the process. It's built in. But again, the proviso is, because as we've seen with the current pandemic, governments have stepped in, it's very likely that society will assume that they'll do so again. So, take up of any kind of policy like this would be questionable, and you'd probably need to mandate it. Would probably need to be a compulsory purchase under this concept.
Arup?
Thank you, Cameron. I echo many of the issues and challenges which you have raised, but again, taking the perspective from a developing markets point of view, where about from 70 to 90% of the population is in the informal sector, it poses more challenges in terms of designing solutions. And the governments have to be a little bit more creative in terms of rejigging or redesigning their existing social security and social insurance schemes to not only expand coverage, but making it more efficient so that immediate liquidity can be provided once these major catastrophes or disasters happen. And that is something which many governments are now looking at, and maybe this crisis is a good opportunity to advance those types of concepts. In the disaster insurance space, we increasingly find the governments going for contingent risk financing from multilaterals like the World Bank and the Asian Development Bank. And many of these contingent financing facilities are basically policy-based loans to the governments. Of course, there is a commitment fee. It's only when a disaster happens, these loans are triggered. But we have some sort of reform measures which are also built in, which look at developing insurance markets, developing better risk information systems, and things like that. So that is where the governments are also, in a sense, trying to see how they can crowd in the insurance markets. The other way where governments can also popularize, the concept of insurance is seen as innovative in the developing world. So the government should encourage more pilots to at least demonstrate how insurance really works and can be effective. Financial literacy is a major issue. Many of these countries have had a socialist past, so the mindset is that the government will come to the rescue, whereas things have not gone that way. The governments have slowly made the individuals more responsible to manage their risks, and that communication has to be very transparent, and people should know what is covered and what is not covered so that they are not under any false expectation. And once they know what is not covered, that is the space where insurance industry can play a role. Coming back to this issue of sovereign risk transfer, quite a few of these government schemes or insurance pools can be developed where the portion of the risk can be transferred away through reinsurance or through catastrophe bonds to the private sector. And that is a role where you also get the critical mass also in terms of insuring and also in terms of diversification. Otherwise, there are many small countries who do not have the critical mass also and really do not pose a compelling business case to insurers and reinsurers. So those are some of the things we need to look at, not only pools at a national level, but also at a regional level. And there have been some attempts in terms of developing and establishing these pools, but it has been a very slow progress. The final issue is on the issue of data. Data is something which is not available. Whatever innovative schemes we suggest has to be backed up with very robust data, and that is something where governments need to promote and work with the private sector in terms of bringing the latest state-of-art data analytics to play in terms of determining risk and also taking major policy decisions also in terms of to what extent the government would use risk transfer mechanisms to manage some of the fiscal stresses caused by catastrophes. Thank you. Yeah.
Thank you very much, Arup. So Petra, are public-private partnerships the only solution? Or in your view, what other solutions could be considered?
Yes, thank you. And thank you for the question. And I also very much like listening to Arup and his answer, in which already is clear that there are also different societies and which require different solutions. And let me start. I want to make 3 points, and let me start with my first point, which have being at tables where public-private is discussed. I think one of the things to start from is that the public-private partnership is not the same as a government backstop to cover losses occurred. And I find that sometimes the discussion very much goes into the direction of first what can government do and then let's see what insurers can add. But that assumes that any government can do that as well. So I think also here it is important that we think broader than just that concept. Now, public-private cooperation is very much needed because we are talking about managing risk of society, and this is where insurers have expertise. So indeed, let's work together, but let's realize it can take various forms. So if IOPA has worked on shared resilience solutions as well, but what we've done is we have tried to identify the different steps and building blocks that are in there, and to also identify what are the risks, what are the drivers of these risks, can they be mitigated? And if they can be mitigated, are those products then available? And if they are, or if not, why is that? Are they bought? And if not, why is that? And added to that, we also have looked at what can you do ex ante to deal with the risk, to prevent the risk, to mitigate the risk. And I also think that here we can really interact and work together, for example, by sharing data across the public, across private entities, and contribute. And I think one of the things that IOPA is doing is building this NetCat dashboards that will be shared with anyone who would like to have a look at it. And I think by being sharing, being open source when it comes to models and data, I think we really can help each other to identify the risk, but also to start finding ways to mitigate those. My second point that I want to make is that mandatory insurance is not a blanket solution. It's often being discussed. I come myself from like a national, Dutch national. We have a mandatory health insurance scheme. I think again, let's look at schemes. Let's see how they work, but also let's realize that it's not the blanket solutions. There are limits to insurability, also depending on which country you're looking at. There are limits to insurance penetrations, and you cannot increase that at all costs. Now, having said that, I mean, as a regulator, we are not in a market for doing business development. I'll happily leave that to industry. But I think what is key is that there is value for money, that consumers understand what they are covered for and what they are not covered for, what they can do about it, and that they understand that. And like Arup says, financial literacy is important, particularly also what is an insurance and what can it do. And here, at least to look at what happened in Europe, IOPA was doing a research on the exclusions of insurance coverage during the pandemic, and what were the expectations for consumers, what situations did we incur, and we hope to publish that later this year. I think what we then finally see, and that's my final point, is that there is not one type of public-private cooperation. I think it's been said by the previous speakers, the next pandemic won't be identical to what we already have. So we need to develop different types of public-private involvement at the local level, national, regional, but also looking at ex post, ex ante solutions and targeting different parts of society, looking at different pricing and cover mechanisms. Because before you reach this ultimate government backstop, if you want to discuss that, some steps are still needed to buffer against the risks along the way. And I think I say that also because we have been looking into what has been done, what has been put on the table, mostly put on there by industry in the past year when it comes to public-private solutions. And so far we see little appetite at the political level. Now that doesn't mean we should stop having the discussion, but I think we should start also having a discussion on what steps already could be taken by the insurance industry. And then at a certain point you might hit you might come at a point where you do think that we need to really discuss involvement of government. But again, that also depends on where you are in the world and how the government then can support and is also operationally able to do so. So I'll stop there and give the floor back to you.
Yeah, thanks, Pietra. So this is a question to all of you to conclude our second round of questions. So we are 18 months down the line in the current pandemic, but we haven't seen any concrete proposals for pandemic risk facilities coming to fruition. Why do you think is that? And what do you think are the major challenges that needs to be overcome? So I'll start alphabetically. Arup, if you can go first.
Okay, thank you, Suzette. In terms of from a multilaterals perspective, we have really not seen a demand from our governments to develop a pandemic risk facility. And perhaps that is one of the reasons, but nevertheless, we are carrying out studies in terms of understanding what are the pandemic risks and what can be the products or solutions which can be built. We are looking at developing pandemic risk models and also run it through along with the physical risks hazards model also, because we are conscious that there might be catastrophes, there might be multiple catastrophes. So that is one we are doing. In the past couple of years, we have done a series of diagnostics on studying the enabling environment for disaster risk financing. And this was mainly focused at physical hazards, but now we are extending that methodology to also look at pandemic risk. So to look at preparedness of governments and subnational governments also in terms of addressing pandemic related catastrophes. And we have it has a 6 axis that way, where we look at the government policy in terms of development of risk transfer instruments. We look at economic conditions and other support functions which are there in terms of legal and regulatory framework, etc. We look at the availability of disaster risk products, including health products. And then we look at the credibility of the private sector offering risk transfer solution, because trust is again a major issue in many of the developing markets. We look at social protection policy, to what extent they can play a role so that they don't really crowd in, they can crowd in the private insurers and don't crowd out the insurers. And finally, we also look at competition from the formal and informal sector, which is unlicensed in nature, because either because they work below the radar, but there are certain schemes which are working very well. But never, as a result of that, the private insurance industry is really not incentivized to enter that space. So those are the areas we are looking at. Thank you.
Thanks, Arup. Cameron, your views?
Thanks, Arup. It is a frustration, actually, and the insurance sector is very anxious to engage with governments on this as quickly as possible. But equally, we have to understand that government focus over the last 18, 24, 20 months or so has obviously necessarily been on firefighting, and they've had to focus all available resource on managing the immediate health and economic emergency. And I think it's safe to say that we're sort of emerging from or we have emerged, perhaps more optimistically, from the depth of the crisis. We're not out the woods yet by any means, and clearly governments aren't yet ready to talk in any meaningful way, I don't feel, at least, about future solutions for pandemic or wider systemic risks. That, having said that, in the UK we've seen some movement. We've seen a real government shift towards focusing on resilience. Back in the summer, the UK Cabinet Office launched a call for evidence on the UK's national resilience strategy. And certainly, I think the hope is that as part of that process, consideration will be given to public-private mechanisms to manage and mitigate systemic risks like pandemic. So, broadening that putting the idea of pandemic into a broader debate around resilience.
Thanks, Cameron. Kai, your views?
Yeah, basically, I would like to reiterate what I said before. I think the perception of how future pandemics might unfold has changed over the past year. I mean, the first impression was Q1 and Q2 last year, when we saw lockdown measures taken at the national levels. Now I think government are pursuing a much more targeted approach. So this might have reduced a little bit the urgency of thinking about future pandemic risk schemes. Also, what I said before, the protection gap or the perception of the protection gap might have changed in light of the lessons that were learned by the public sector and by the private sector. So that might be a reason for this reduced sense of urgency. On top of that, and here I'm sharing something that happened actually in my country here in Switzerland. Earlier this year, the private insurance industry put forward a specific proposal with skin in the game from the industry, with a government backstop. So something that is not too unsimilar from what is being discussed in the US as the Pandemic Risk Insurance Act. The Swiss industry proposal would have been mandatory, and I totally agree with what Petra said, especially in terms of the context of health insurance. On the other hand, when you look at pandemic BI risk, when you look at the risk pool, it's arguably even more heterogeneous than anything else. You have a restaurant owner who takes the full hit, and you have a small IT consultancy boutique owner who might benefit from the pandemic. So how do you apply risk-based pricing to such a risk pool? It's a huge challenge, and the conclusion was that cross-subsidization is needed. So solidaric risk sharing across the society is needed, and this touches very sensitive political issues, and the bottom line was that the majority of the Swiss business community said no to that because they felt this is just another tax. So that's why the scheme ultimately fell through. It's just a case study from Switzerland.
Thanks, Kai, for sharing that. Petra, any contributions you would like to make?
Yeah, maybe briefly a few observations. I think first of all, what we do see, for example, in the travel insurance market is that there is products now that offer pandemic cover for pandemic risk. I think that for supervisors here, we need to see if what is promised really can be delivered, and if people really understand what they buy. So I think at a micro scale, we see some products. Of course, at the large scale, the real systemic risk, I think I would say three things why it is maybe not happening. I think at a lower level, maybe less visible with the final results on the table. I think at the lower level, there's a lot happening. There's a lot of discussions taking place, even though people maybe not yet agree or wonder what the directions they should take. There's a lot of discussion. There's more data coming available. There's more lessons to be learned. And I think that is a good thing because these are not easy questions, and there are still lessons to be learned. I think a second is, and that's been said before, only looking at pandemic at a time that you also have net cat risk and cyber risk developing, you may want to take a broader view while you're at it. So that will take a little bit more time, but I think that is good. And again, I think that is starting to happen or is happening at a maybe less visible, but still very much there space. And finally, governments are currently still in the midst of dealing with a crisis. I think that is one. And second, I think that examples where indeed the industry comes to the table and first explains what they can do and then starts with where government support will be needed, I think will result in a more listening ear on the other side of the table. And I think that was not how the discussion started. So I think all in all, these are reasons. But again, I'm very positive actually that the dialogues like today that are taking place will go to a point where we will find solutions because we need them. And I think that is something we all agree on.
Yeah, no, also agree. Thank you, Petra. So I can now share with you the results of our first poll. If we can just get that up and running, please. Yeah, so I think there was an overwhelming conclusion from that poll with the two responses that got the most ticks. The one was that 63% of the audience feels that public-private partnerships is the most effective mechanism, with the second one at 27% government-funded scheme or stimulus packages. So clearly the audience also of the view that the best solution would be a government, where government is involved. All right, I am conscious of the time, and we still got a 2 rounds of questions to go through, and also would like to give time for the audience. So if I can move to the next round of questions, where we would like to consider a key issue for the IAIS and its membership, and that is, what can the perspective, what is the perspective on the role of the supervisor in developing or supporting initiatives to address protection gaps. So if I can start off with you, Cameron, first, and then also ask Kai just to come in following you on this question. So noting that initiatives to develop shared solutions such as public-private partnerships are mainly driven by government or by the insurance industry, as we discussed in the previous round, where can regulators or supervisors play a role? So, Cameron?
Thanks, Suzette. I mean, many of the arrangements that we're talking about, pools, backstop arrangements that are currently being discussed, they're based on fairly traditional insurance structures, mutualization, indemnification, with that reinsurance backstop. So they could be established through commercial, public-private arrangements that insurers are already familiar with, and that regulatory systems, importantly, can already account for, if you like. So whilst that might suggest a limited role for supervisors, I think there are a couple of important areas where supervisors can play a role to bring these things into existence, into being. I think notwithstanding what I said about governments not yet really being ready to engage on future solutions, I think focus is inevitably going to start to turn to the longer term and to investing in resilience, as we've said, broader resilience issues. And I think it does present an opportunity for supervisors who feel there's a protection gap in their particular jurisdictions to use their regulatory expertise, their understanding of risk, their knowledge of the local market, and so on, to educate their national governments on how these sorts of structures, public-private arrangements, could be part of the broader resilience solutions in the future. As we've said, government buy-in is, and Petra just mentioned the point specifically, government buy-in is really a prerequisite, it's essential to developing any kind of solution. And I think supervisory influence is going to be key to giving governments the comfort they need about an approach. And there's benefit, supervisory benefit as well, actually, both prudential and conduct regulators, because having resilient structures in place can help to support both financial stability and policyholders ultimately. And secondly, on a related point, supervisors can use their expertise to explore options, I think, for potential solutions. IOPA's issues paper on shared resilience solutions, I think, for example, and a paper published on increasing the insurability of business interruption for pandemics. They've both been really helpful contributions to the debate. And when you get output like that from supervisors, it's naturally authoritative, and it has a number of benefits. It can form the basis of the solutions. It shows commercial partners in the insurance industry that there may be regulatory support for or endorsement for schemes, and it opens the door for conversations between industry and supervisors.
Thanks, Cameron. Kai, your perspective?
Yeah, thank you, Suzette. I would start with the proposition that maybe, legislators are certainly in the driver's seat here, but still I believe that supervisors can make a major contribution in really, as I said before, harnessing the insurance industry's potential contribution to risk mitigation and prevention, encouraging measures that limit the loss potential in the non-damage business interruption space. And here we might want to differentiate between pre-event measures and post-event measures. Pre-event measures, simply speaking, could look at the liability side, could look at the asset side. So how could supervisors incentivize insurers to include risk prevention, risk mitigation aspects in their underwriting? What might be incentives on the investment side, making insurance investments in relevant critical infrastructure, for example. And the third idea, pre-event, might be to think about insurance-linked securities. This is being discussed as a potential approach to addressing protection gaps. Not in the BI space. We are not there yet. That would be way too premature. But more generally, moving the frontier of insurability by tapping into institutional money, basically, by tapping into capital markets. And a number of supervisory authorities in Asia, especially, and I think thinking of Hong Kong or Singapore, are going down this route. So that's pre-event. Post-event, as we have seen during the pandemic, I think supervisors can do a lot in terms of partially relaxing conduct requirements, in terms of offering more flexibility on the solvency front, more flexibility when it comes to calculating liabilities. When you think of the fact that government response usually leads to a drop in interest rates. So these are small but very important things that supervisors could consider post-event. So long story short, I would start with the proposition that encouraging preventive measures is key, and then I would suggest to differentiate between what can be done pre-event versus post-event.
Thank you very much, Kai. Maybe the next one is to you, Pietra, as a supervisor. So in what ways can supervisors engage with governments and policymakers to impact the development of initiatives to address pandemic protection gaps?
Yes, thank you. And we've been thinking about this as well, of course, and I think we can add to the discussion having a clear mandate for financial stability, consumer protection, and managing risks, but not having a commercial interest. So what I think, first of all, what we can do is we have knowledge of the prudential and conduct risk across the markets, particularly, for example, with EIOPA at a European level, we have a lot of information on what is happening in different markets when it comes to risk assessment, risk prevention, etc. So based on that knowledge and that overview, we can model risk, do financial stability analysis, and contribute to analysis of the drivers of the risk that we are seeing and potential policy options that are being developed or available. Now that means we do need access to data, maybe sometimes also data that is not either for free available or even collected. But I think these are things to consider to see that we get an overall picture of exposure and vulnerability. And then it will be key that we make that data available. and we are transparent on what models we use. And so share that back through an open source approach. I think that's the first. The second, when it comes to risk prevention, I truly believe that private insurance initiatives can very much reinforce and implement prevention measures, also prevention measures that are put in place by authorities, and public finance could support that, making it, for example, conditional on certain implementation of prevention and adaptation measures taken through insurance. So only support if you took all the coverage that was available in the market ex ante. Now here again, here is a question of why do people take coverage for these damages, and IOPA will be running a pilot exercise, and we might do more in the future, where we want to assess between December and March why people are taking coverage, for example, for another systemic risk, net cat risk, and why they are not. And also that insight in behavior will hopefully help, as long as we didn't share it back to the market. So I think here, at a technical level, coming from a non-commercial view with a mandate to manage risk, I think we can just contribute to the discussion and make sure it's well informed and of what, both with data as well as with what is happening in other parts of the world, or in my case in Europe. Thank you.
Thank you very much, Pietra. So just to conclude this round, Arup, are there lessons we can learn from experience with initiatives to address other types of risk that can be applied to pandemics?
Thank you, Suzette. I'll carry on from where Petra left. Yes, in my previous intervention, I did mention one example where we are trying to learn from what disaster risk insurance can offer in terms of lessons to manage pandemics. The other thing is also understanding the risk layering approach. The high frequency, low losses have to be managed by government reserves, and that is where insurance cannot play a role, or even if insurance products are made available, it will be becoming more expensive. Then the second layer is the low frequency, medium loss layer, where insurance players can play a role, and that is the space which needs to be identified for incentivizing the insurance players. And then there is the low frequency, very high losses, which is the backstopping role, or where public-private partnerships, reinsurance arrangement, Kai referred to ILS and all, which they can really be good interventions, and also instruments which governments can consider. So those three layers need to be very, very clearly identified. In many of the developing countries, the regulator also has a developmental role. The D role is something which is expected from the regulators. So they need to also see how they can promote good behavior in terms, and in this sense, I take this point from Petra, where she referred to interactions with the public finance authorities, because a lot of those integration needs to take place, and the regulator can be a good intermediary between the industry and the government while taking these discussions forward. And in this context, when we talk of public finance, we need to also look at how we can, in the development role space, the regulators in many countries also see whether the insurance companies' investments are properly directed, and if they can incentivize insurance companies to invest in the social infrastructure, like building hospitals and other road networks and things like that, which helps in the long run to ensure that people get access to treatment in a timely manner. That is also something we need to consider. We just should not think only about the protection space, but that investment space is also very, very important. And increasingly, because of ESG compulsions, insurance companies, along with other institutional investors, are looking at enhancing their involvement in that area. So that is also something which insurance supervisors can incentivize. Thank you.
Thank you very much, Arup. So before we go to our final round of questions, I would like us to go to our second poll. Let me just give a second for the team to put up. Okay, there it is. So just by reading out the question, what type of systemic risks will challenge the capacity of traditional insurance models to provide cover in the future? And while you as the audience select your options, I will now move to our final round of questioning before we get to the audience questions and answers. Now, this round will focus on looking ahead and consider how we can apply the lessons of COVID-19 to future adverse events or risks. If I may ask the panelists just to be brief in your response, because we are running out of time, and sorry to do that, because it's a topic that I guess we can talk about the whole day. But let me start off with you, Arup. How much focus should governments and industry put into preparing for pandemics in the future? Are they 1 in 30 to 50-year events that can't be mitigated? So where should the focus be?
Well, the focus, of course, has to be first on the epidemics from a developing country's perspective. We need to contain the epidemics so that they don't go to the pandemic stage. So it would be a good idea to develop epidemic risk financing frameworks. And we are in Asian Development Bank are already looking at how to develop this type of a framework so that countries have an enhanced ability to prevent, detect, and respond to outbreaks. The government and the industry can have better access to vaccines and medical countermeasures. We are able to understand and communicate risks better. From the ministries of finance, the public finance authorities, we can develop these contingent risk financing loans and other risk sharing and risk transfer instruments. So those are areas also we need to understand. And then there has to be a multi-stakeholder coordination with a lot of other international bodies, which includes the WHO, the UN, the OIE, so that this coordination and response can be properly coordinated. And finally, we need to also develop the capacity of the human resources at different levels so that they have the skills to communicate and manage these outbreaks. So we would like to, from a multilateral point of view, use our resources in terms of the risk reduction part, strengthening the public health core capacity, improving access to technology, reinforcing data collection, strengthening resilience and stability by working with regulators, and also enhancing awareness and capacity building. And this all looks towards ultimately having a cooperation platform or a regional cooperation mechanism through which development partners, research institutions, standard setting bodies, data scientists, financial industry representatives, they can all participate. So that is stance at this point in time. Thank you.
Thank you very much, Arup. Kai, are there other types of adverse events or risks of this scale that insurers, supervisors, and governments should prepare themselves for in the future?
Well, yes, I think you will not be surprised that I will start with cyber. I mean, I think the pandemic has taught us what a peril without geographical borders is. And the obvious other example we could think of is cyber, a global cyber event. And in that context, the Geneva Association has been thinking about specific scenarios, and we will be publishing on that very, very shortly. Scenarios such as widespread, contagious malware dissemination. Think of the SolarWinds episode, this major software supply chain attack. We'll also look into a major cloud outage scenario, and this is quite worrying because we all know how concentrated the market is for cloud service provision. And of course, the scenario which is the most daunting one is a global infrastructure disruption. So a global blackout scenario, power, internet outages. This scenario could easily dwarf the economic cost that we have suffered as a result of COVID-19. And this is certainly something that defies any criterion of insurability, and I think where governments have to think very, very hard. Such a scenario would be much more daunting than the pandemic because it would hit the entire economy and not only the most vulnerable segments that were so badly affected by the pandemic. So let me stop here, Suzette.
Yeah, no, thank you very much, Guy. So this question is both to you, Petra and Cameron. So maybe Petra, if you can go first, and then Cameron. What can insurers and governments learn from COVID-19 that could be applied to future pandemics or significant adverse events? Petra?
Yes, thank you. Again, I'll say three things. I think first, from a consumer protection perspective, I think we should start paying more attention to the contractual terms of insurance coverage, to the extent that people understand what they are insured for and what they are not insured for, to the extent from a supervisory perspective that is also clear from the policy. And again, financial literacy here then is very important. I think that's the first. The second is we really need to collaborate on risk assessment and risk prevention measures for systemic risks, and building on data, on models, to be able to identify what the risks are, where the gaps lay and why they are there, and what are the drivers, including promoting preventative measures, but also just with preventative measures, assessing what risk is then still residual, and how we can deal with that. Final point is that any narrowly solution built today will not address the problem of tomorrow. So first of all, I think the socio-economic impact that is very much there should be more included in and considered in forward-looking developing policy options. And I think we need multi-peril solutions, looking at different types of perils, but also at different ways to address those risks, including indeed any other forms of risk that will have a systemic character when they actually manifest themselves.
Thanks, Petra. Cameron, your perspective?
Thank you. Yeah, I mean, I think two things for me, just up front, importance of dialogue and planning, getting ahead of the game. And the second one I'll talk about briefly is as Petra said, clarity and simple products. On the first point, over the past year and a half, there's been really intensive dialogue, I think, between government and the insurance industry. And we've found ourselves having to work together to manage and try and find solutions that have just popped up virtually on a daily basis. So in the UK, for example, I'm thinking about solutions to enable live events to restart, a trade credit insurance scheme with government support, thinking about insurance arrangements for care homes, for hotels that for a while had to accommodate key workers, for pharmacists administering vaccinations, which is not part of their day-to-day kind of activity. So conversations of that kind were happening weekly, daily, sometimes several times a day. And it was pretty stressful times, I have to say. But I actually look back quite positively on that period of intense dialogue, because while we were admittedly, there was some reputational issues, challenges for insurers at the time with government around BI claims, of course. I think actually our relationship with government, and certainly with with key officials who we were dealing with on these issues was actually deepened and strengthened, and it did actually feel like a partnership. And surely that sets us up for a fairly meaningful conversation on these future challenges. And I think we'll need that. We'll need to get moving fast while the memory of COVID, if you like, is fresh in our minds, because I think there's a real risk that as time passes and other government and industry priorities rise up the agenda, any sense of urgency in finding solutions could fall away. So there's a risk there. So dialogue and planning are paramount. And again, I'd echo Petra on the importance of clarity. We've really learned about the importance of simple and clear products. COVID-19 shone a light on the insurance industry because, as we said right at the start, most businesses weren't covered for BI from a pandemic when they thought they were. And then you had the subsequent disputes between insurers and their customers and legal test cases on business insurance policy wordings. And they all highlighted really clearly the need for the global insurance industry to speed up its efforts to build simpler products that are more easily understood by customers.
Yeah, thanks, Cameron. As they say, we shouldn't let a good crisis be wasted. We should take the lessons learned from them. So that concludes our round of questioning. We do have the results of the second poll available. So let me just pause and give the technical team. Oh, they are quick. So from the poll results, I guess the next crisis or big event the audience feel would come from a climate event, with 52% of the responses indicating such. And then 25% to a cyber risk or a cyber event, and then 60% for pandemic. So audience, thank you very much for your input into the polls today. We now have time to address some questions from the participants and the audience. Let me just see, because I haven't seen any questions. If there are. Let me just pause to give the audience a bit of time just to post a question that they've got. Well, while we wait for the audience, maybe a question that I can ask you, Kai. What risks will develop after the pandemic? I mean, I guess relating to the pandemic.
Well, this is gazing the crystal ball. I mean, we have just heard that there's a much increased awareness of climate risk. I think climate risk and cyber risk, there are fundamental differences in terms of how insurers can respond. I mean, climate risk is a risk that challenges the role of the insurance industry longer term. If climate risk becomes uninsurable and insurers withdraw from providing coverage, this is a question that relates to their relevance to society. This, for me, is the real challenge with climate risk, and not any short-term hits that we might see from an increased frequency and severity of events. What I'm really concerned about is a shock-like event, such as cyber, this infrastructure disruption, or solar flare, a solar storm. So events that would affect the entire global economy and the entire global society. That's something where we need the governments to be in the lead, and not just on a national level. This is something that really requires a globally coordinated effort at the highest levels of governance. So that would be my response, Suzette.
Thank you. Thanks, Kai. So a question from the audience, which I would like to address to you, Arup, first, and then also Cameron, if you can weigh in as well. So what impact did unemployment during the pandemic have on underwriting risk? Arup?
Well, I am no longer an underwriter, so but let me try to see from a development bank's perspective. So, as I mentioned, in emerging market economies, a large section of the population is in the informal section. So the unemployment there is very, very seasonal in nature, and some of the unemployment is also structural in nature. So unemployment definitely had problems, but it was not properly measured. People definitely lost jobs, and they did not have access neither to insurance nor to social insurance schemes because they were not part of. So that is the challenge we need to address in terms of identifying such members of the population in countries who are in the informal sector, like daily wage laborers and things, people like that, and see what type of recouping mechanisms can be developed so that their livelihoods can be protected. Because a lot of establishments had to shut shop, and therefore they lost jobs almost overnight. So that is the challenge from a policymaker's perspective and also from a political perspective, because these constitute a very, very important vote bank. Thank you. Yeah.
Thanks. Cameron?
I can't really add too much to that, to be honest, Suzette. Like Haru, I'm not an underwriter, but I'm very happy to take the details of the question and consult with my colleagues and provide an answer later on.
All right, thank you. So another question from the audience, and let me read it, and then I'll direct it to the right panelist. So given that the two detailed pandemic risk sharing mechanism proposals that were made to governments were rejected by governments after consultation with businesses, how could any insurance-like product be made attractive to potential policyholders? And I don't know who's up to answer this question. If you can just show your hand, otherwise I'll select. Petra, do you want to take this one maybe? And Kai?
Well, maybe just observing that more as a regulator, not being involved in that particular dialogue. But if I think that what you see is that there is a society in the midst of dealing with a crisis, there is a government dealing with a crisis, and then there is a group, insurance, say, well, going forward, we need to deal with this. I fully agree. We need solutions. I agree too. And as such, we need you to first step up and commit to this or that, and then we can do that. And I think maybe the timing is not right. Maybe stakeholder management among businesses and the realization that there is a need that needs more attention. And maybe the start of the dialogue is also, I said this before, maybe the start should really be the true risk analysis of what are the risks, why are they not insured, can we find products to do that, why are they not bought, these products, if they are there, and then what is the residual? And I fully agree that there might be a residual, but if you approach this from that way on and start with what we can do, but where the limits are, but also include the stakeholder management and realize at what point to bring it in. I do agree, however, with Cameron that you would want to do it when we still have a fresh memory of what happened. Maybe that would be helpful in the discussion. And again, I mean, discussions didn't stop. There's just not a final conclusion yet. But then again, it's not an easy discussion either. So keep talking, but also look for your own role in this, because I do think for insurance to remain relevant, they also should see a role that is there. And I think they can.
Yeah, thank you, Petra. Kai, I'm gonna relieve you from answering this question because unfortunately we have run out of time. I mean, it's a complex issue, and we can talk for the whole day or a week, I guess. But I really do hope that today's session has provided valuable insights to those that participated today. So thank you again to our panelists, Arup, Petra, Cameron, and Kai for taking your time and participating with us today. From our side, it was a real pleasure moderating today's webinar. I would also like to take this opportunity to note that there would also be a IAIS A to II public dialogue to be held next week on the 25th of November, which will focus on pandemic risk and opportunities to improve insurability. And I would like everyone to join the session, and if you haven't registered yet, please do so. Before I go, I would also like to remind you that there will be another panel later today at 4 o'clock Basel time on innovation, which will explore issues around the ethics and governance for artificial intelligence and machine learning. If you'd like to register, the details are available on the IAIS website. Thank you for your attention, and please have a wonderful rest of your day. Goodbye.